Many of you would have heard the news that government is introducing the finance bill wherein the income tax benefit which was being provided to the debt mutual fund investors is being withdrawn. What it means and how it's going to impact you, that's something which we are going to be discussing in this video. My name is Raghu, a certified financial planner by qualification and founder of FinSim. Debt mutual funds are a category of mutual funds where the funds are pooled in by the fund manager for the purpose of investing in fixed income securities. Now, what is the definition of fixed income securities? Any investment which we are making which will give us a fixed income on a regular basis can be termed as fixed income securities. If I have to take examples of few, I'm sure all of you would have heard about the government securities, where government borrows from the public or corporates and pays a fixed amount of interest. Similarly, we have corporate bonds as well, wherein corporate companies and organizations borrow for short as well as long-term duration in order to expand the business. And also money market instruments, wherein in order to meet few days or few months worth of liquidity issues, corporates borrow certain amount of money. That is also another vehicle where debt mutual funds make their investment. Let's now understand how debt mutual funds are taxed at present. For the purpose of calculation of capital gains, the capital gains are classified into two categories. One is short-term capital gains, wherein if an individual sells any debt mutual fund which he is holding for less than 3 years, that any capital gains arising out of that would be classified as short-term capital gains, where the tax bracket of that individual would be applicable on the gains made and tax will be collected thereof. If an individual is holding a debt mutual fund for more than 3 years, then the same capital gains would be considered as long-term capital gains, and the slab which is applicable in this case would be 20% after indexation, or if we were to not account for indexation, 10% on the capital gains would be taxed by the income tax authorities. Let's try to understand with an example which will make life pretty easy. Let's assume the individual went ahead with the investment on 1st of Jan 2020 with an investment of about 1 lakh. Date of sale would be after 2 years, that is 1st of Jan 2022, and the sale proceeds now account for 1,12,000 rupees. Now the holding period is about 2 years, which is less than 3 years, so this would be classified as short term. Capital gains would be sale proceeds minus the purchase amount, in this case 1,12,000 minus 1 lakh rupees, which will result in 12,000 rupees. Tax applicable in this case would be 12,000 rupees. Assuming an individual's tax slab is 30%, he will be liable to pay an income tax of 3,600 rupees on this capital gains. Let's now try to understand long-term capital gains with an example. If you have invested 1 lakh rupees on 1st of Jan 2018 and sold it on 1st of Jan 2022 for an amount of 1,27,000 rupees, as we are holding it for more than 3 years, that is for a period of 4 years, this will be classified as long-term capital gains tax. And as we earlier discussed, we have two options, whether to use indexation or not to use the indexation. Now this indexation table is something which we can extract from the government website. I have taken the indexation points which are applicable for the relevant years. That is for financial year 2017 and 2018 it is 272, and for financial year 2021 and 2022 it's 370. Now the whole purpose of applying the indexation table or indexation point is to ensure that our original investment is at least inflation adjusted before we compute any capital gains out of it. In this case, the sale proceeds is 1,27,000, and when I deduct it with the indexation formula 1 lakh divided by 272 multiplied by 370, I get a capital gains of 10,455 rupees. On this, tax which would be applicable would be 20% of it, resulting in 2,091 rupees. Or the second option which an individual can exercise is without indexation. I would go ahead with a flat sale proceeds minus my capital invested, which is 1,27,000 minus 1 lakh rupees, resulting in a long-term capital gain of 27,000. This is going to be taxed at 10%, which is going to result in a tax outlay of 2,700 rupees. Now that we have understood what the current taxation principle says, let's try and understand what the Finance Ministry is proposing now. Finance Ministry is proposing to do away with the classification of capital gains between short term and long term. We are now going to have only capital gains tax, which is going to be irrespective of any period. It will be taxed as per an individual's tax bracket. Whether an individual is holding it for less than 3 years or more than 3 years, it really doesn't matter. And any capital gains which is arising out of it is going to be completely taxed as per the tax slab of an individual. And long-term capital gains is completely eliminated. So we are no longer going to see any indexation benefit arising out of long-term capital gains. This is going to bring the capital gains on debt mutual funds in par with the other investment vehicles like bank fixed deposits. As I had explained earlier, now bank fixed deposits as well as debt mutual funds, there won't be any differentiation as far as the capital gain taxation of both of these products are concerned. However, when it comes to benefit or benefit of security, bank fixed deposits are backed by deposit linked insurance schemes. So it has an edge over debt mutual funds. However, for certain corporates who hold only the current account, who do not enjoy the benefit of interest rate on their current account, they can still explore debt mutual funds for parking their liquid corpus. Hope this short video helped you in understanding the taxation elements associated with debt mutual funds. Feel free to reach out to us for any consultation relating to your financial investments. Would be more than happy to help. Thank you.